All right. Good morning, everybody. So we made it through the other side of PPI and CPI and POW. What do we have left? We're really not done. We still have jobs data. We have OPEX at the end of the week. And then next week, we have NVIDIA and we have the VIX expiration. Now, if you read Spot Gamma this morning, they had a really interesting comment at the very start about this resistance band between SPX call wall. Well, we'll just use, SPX 5320 and 5300. It's a resistance band. Not much of a band when you look at it on a weekly, but this is the resistance band. On the SPY, that would be 530 down to 500, I believe. They had a picture of it in the founder's notes. They also published an OPEX document, so I went ahead and I shared that with everybody too. Just take your time to read it. It's not a must-have before the market opens, but it'll help explain what we expect out of the market at these levels. This is significant resistance that we do not expect to get through. So we might peak above that level, but we're not expected to hold above that level, and we're not expected to continue to climb beyond that level until at least after OPEX. OPEX, if you're unfamiliar with the term, is options expiration. It's a monthly event. It happens on the third Friday of the month. Think of it as options welfare checks. Nice little joke. So you can always just look at your calendar and count, is it the third Friday or not? It is. That'll be options expiration. Back in the day, when there was only monthly expirations in options, this was a really big deal. Don't get me wrong, it's still kind of a really big deal, but it's not as big as it used to be. There are some institutional trades like the Fidelity. Uh, there's a Fidelity collar. There's a couple other really big ones that there's been research on over the years. How much will those big trades affect the markets, and will we pin at particular levels? And pinning is almost a thing of the past, almost at this point. But Spot Gamma does continue to highlight areas where we could pin. Butterflies are kind of cheap, all things considered. A butterfly has a very low probability rate, a POP, probability of profit. And in the options world, if your trade that you're developing has a low pop, it's generally cheap. Now, the options don't know if you have edge or not. So if you can increase the chances of that trade being successful, even though it calculates as a low pop, you've got a low risk, high profit trade. Those are great. It's one of the reasons that butterfly trades are so good for small accounts, because the losses are always very small and the potential payouts are usually pretty good. So you can miss on those 5, 6, 8 times and win one, pay off all your loses and double your account. It sounds good, right? But I can tell you from experience that it does not feel good to lose 5, 6, 7, 8 times in a row and keep coming back and saying, that was fun. I want to do it again. And then lose again and again and again. That's what makes butterflies so difficult, is that loss factor. Even if the losses are small, psychologically, it just doesn't feel good to get kicked in the face over and over again. But when you can apply some edge to a butterfly strategy and increase your chances of winning, the options don't know that you have edge. It will still price as a low pop. I mention this because I have done mechanical trading systems that just put on a trade on a particular day because it's that day. Like, well, it's time to put my Tuesday trade on, time to put my Thursday trade on, and it has no impact whatsoever on whatever the market is doing. Up day, down day, FOMC event, doesn't matter. Just, well, it's Thursday, time to put my trade on. I did that with butterflies, and even with edge, the win rate, which is supposed to be about 10%, went up to about 35%, which I was really impressed with. I was happy with the outcome. But that still means that, it's 65% loss rate, and that's hard to chew on. So this pin that they're talking about is this shaded area that I just mentioned. And we're basically in the middle of that right now, right? 53.10 would be the middle. So you could do a butterfly, which would be the cheapest route. You could do an iron condor on that range, but I don't really like that one as much because your risk goes up. You could do a double butter or a double calendar. That can increase your range significantly. So you could basically triple the range that's already there. Back in the days when I developed that strategy, I called it the Marcus trade. Those who've been around here for a while, you know which one that one is. The main takeaway, though, is that we're expected to hold that 5,300. So we can wick down below there for sure, but we're not expected to stay below there. And in the founder's note, they did mention if we do break that level and start moving to the downside, the put levels or any sort of optionality levels that might be able to help us out, they're kind of a long ways off. So we have plenty of room to fall. If we cut through that 5,300 on the SPX or 53.24 on the ES, then we can revisit yesterday's open, which would be the lower ADR line, 52.75. So we're talking about going from, 53.50 to 52.75. It's a heck of a drop. So we don't want to see that drop, I guess is a good way to say it. We just don't want that. Let's just not do that. Right. Because of the numbers that we got this week, the bad is good and good is bad. We're still in that dichotomy. And there's been some talk of an increase in the potential for a rate cut again, right? Like, oh yeah, okay, here we go again. The market is starting to price in a rate cut. At least that's what I was hearing on the radio. And I'm looking through these, trying to find, well, where is that cut being priced in? If we go to December, our current rate is 5.25. We can see 5.25 right here. The chances that we'll still be at 5.25 in December, 27%. The chances that we would have, we're way over here, 6.8%. The chances that we'd have a 25% reduction is 27. chances that we'd have 2 rate cuts, 38%. Go to November, still the odds of us staying at our current rate into November, 16%. For September, 28%. So if you look at July, the likelihood of us still being at our current rate is the greatest. So no cut into July. But when we see September, we can see that the probability that we get a 25% reduction or we get 1 rate cut for September is the greatest out of all of these choices. A 50% chance right now that we would get a rate cut in September. That's the target that we want to focus on. Between July and September, we have QRA. I know it's that time of year. It'll be the 3rd QRA of the year. It's in August. And so this September meeting after that August QRA will have a lot of data behind it. Between now and then, nothing else is on the table for an FOMC rate cut. That could change, right? One of the things that can change that is the job numbers. Now, even though we've discussed how that little blip in the job numbers was likely due to the New York school system having that week off or that week and a half off, and bus drivers and janitors and everybody was filing for a temporary unemployment, it still bumped the numbers up. And the market's not going to like this if we don't continue to get bad job numbers. But every other metric that we're looking at is showing that we're not expecting to get bad job numbers. So I wouldn't get your hopes set on a rate cut in September. I think the market's just getting a little overly excited here again. The thing is, even without the rate cuts, when we started to pull back here, I had mentioned back in the day when we used to have a really nice, clean rally to the upside. This is all pre-COVID. That every once in a while we would need a decent pullback to kind of clear the slate and start over for a new leg up. It's what we have to have, right? Just take a look at what the market has done, especially pre-COVID, with these just run and run and run and run. We have to have some decent pullback along the way, right? So we started to pull back. And I said, if it's staying true to form, this shouldn't be more than a 5 to 7% pullback. .91%. And I don't point this out to brag and say I was right. I pointed out this to point out the fact that rate cut or no rate cut, FOMC and OPEX and everything else, the market still did what it was supposed to do, right? We were supposed to get a 5 to 7% pullback to kind of clear the slate and start over for another run up. And gee golly, guess what? That's what we got. All right. You'll have to work with me as I'm losing my voice. I went to see my doctor the other day, and of course, what happens? I get sick. Imagine that. This move here, I kept saying, wasn't bearish until we broke this low. And it wasn't even showing any warning unless we set a lower high. As long as we didn't set a lower high and we didn't break that low, we weren't bearish. We do have to be worried of a situation where we would have done something like that and set that lower high and then broke that low. This is what we were worried about. Well, that's done. That's off the table. Now we've got sort of this scoop pattern. Now, granted, this is a more complex topping pattern than this one, but it's still the same. You can always go back in the past and find an example of what you currently have to help you better understand what's going to happen next. Will it work? No. You can find a lot of examples and they might disagree with each other. Some of your examples might be a bullish outcome, some might be bearish. But it's usually a good starting point. Find an example in the past and see if it lines up with what you're currently dealing with. If you can't do it on the time frame you're on, move up to a bigger time frame. Generally, you'll find that'll clean the chart up for you. So right now we've had a really nice pullback and we ran up and broke out. Kind of like this really nice pullback. And we ran up and broke out. This one's a little different. It had very clean, obvious defense. And it was just an amazing move through that whole thing. It's a little different than where we're at now, but it can give you those same clues, same hints. Now that we have something to work with, somebody mentioned yesterday, and I get the sentiment, but when I read it, I was a little frustrated. They said, man, I hate blue skies because now I don't have any levels. On the one hand, I get that. I do. It's nice to look back, to look left and see levels that we can play on. But come on, we've got levels to the upside. Just because we haven't been there yet doesn't mean we don't have levels. So let's just start with the obvious one. Measure the pullback. Every single textbook out there will tell you to measure that pullback. We can measure the entire thing, and just like we would do on a head and shoulders or a cup and handle or a flag, measure that pullback and plot the whole thing forward. I'm showing you how to do it with a box because if you don't have fancy drawing tools, you can still do it. Just use a box. Use a circle. Draw a line if you have to from the top of that to the bottom of that, and then just grab the line and move it. Do whatever you have to do to figure out where 100% of that move is. 50% is the layup, the easy shot. 100% is the full measured move. We can even add to this my levels, the 111, what I call the warning center, and the 1, 2, 3, 6. If we're going to stall, it very likely will be around that 111. And it doesn't matter that we broke through it. We can still stall. But if we can close above that 111, we can continue the move to the upside, and we would look to get into 53.40, just round up a little. And then we would expect opposite candle color at that point, or a doji, either one. We would expect a pause there. And it can be above it. It can be slightly under it. We're not talking about perfection here, depending on the line. We just wouldn't want to see a continued drive towards this 50% mark. We would want to see it stop and consolidate at that green line. This is a cup, by the way, without a handle. We shouldn't get a handle now that we broke through and above. The opportunity for a handle is past. If we were going to get it, it should have already done it. But we can get a Busby. That phrase seems to mess with people. I came up with the phrase because of a behavior that the market does. When we have resistance and the markets fight resistance and fight it, fight it, fight it, and finally break out of that resistance. Before a really good trend, we often see this. Price in a range, fighting resistance. And when it finally breaks out and before it starts that trend, a lot of times a market will pull back to that old resistance and validate that old resistance as new support. Well, that's a mouthful. That's a conversation. Like if I'm trying to write that to somebody, I've got a lot of writing to do. And I got tired of writing it. I got tired of saying it. And instead I said, it's a Busby. Just give it a name. Breaking out of old resistance and coming back to test it, making it support. It's a Busby. It can be to the downside. It can be to the upside. It doesn't matter. We've now broken out of a really big range. And we can count that old high as resistance that we broke through, which means we could now come back and test that, turn that old resistance into proven support. Busby. At that point, it's a Busby. It could overshoot a little bit. It could front run a little bit, meaning it doesn't even get all the way to the bottom. Now, some people have heard me talk about this and decided that'd be a good trade. Catch the bounce, run it back up. I don't really like to play the trade because it only owes us back to this top point right here. And usually that distance is not enough. It doesn't match my risk to reward. I like a 5-to-1. And usually that distance is just not enough to get my 5-to-1. But as a signal, as a pattern, as a setup that gives me forward guidance, seeing a Busby play out gives me confidence in a potential trend. So let's see if we get this Busby or not, or if it just continues to run with no pullback at all. A high momentum breakout won't pull back. It'll just keep on running. And that's okay because it's high momentum. It's kind of what we want it to do. But we don't want a high momentum trade to pull back and let us in, because that means the momentum is gone. Buy low and sell high, waiting on a pullback works great for trending markets. It's a poor concept for a high momentum market. In high momentum, we want that thing to move. We don't want the pullback. So it's okay to have a trend where we pull back and run and pull back and run and pull back and run. That's fine. It's trend. It's great. But that's not high momentum breakout run. So far we're on track. The breakout is there. I point out the fact that everything is doing what it's supposed to, regardless of whether or not your Fed cut, not cut, whatever, it doesn't matter. We're on track. It's doing what it's supposed to do. Keep your eye on these Fed numbers. It's not like you got to stare at them all day long. Just drop by once or twice a week and see what they're doing in here. Small caps are down the most, not even at 0.25%. The Dow is flat. Europe is flat. The S&P barely up, not even 0.1%. And same with the NASDAQ, but they were up more. We can see all of the jobs data we're going to get today. This isn't the big jobs data. If you're newer to trading, that might seem a little odd, but there's a lot of different jobs data out there, and they're not all equal. So this one, it matters, but it doesn't matter as much as non-farm payrolls. Right now, what we're really focused on is the initial jobless claims. If you didn't hear us talk about this, the last initial jobless claims had a little bump in it, and that's because the schools were out for a small period of time. There was new unemployment claims, and this is not a reflection on people that lost their jobs. I live in Kansas. It's a farming and factory state. A lot of these factories will shut down for 2 weeks in the summer to do major housekeeping and, put in new equipment, things like that. And during that 2 week down period, a lot of people claim unemployment for that 1 week or 2 weeks. And then they go right back to work again. So it's a momentary blip in the numbers. We can see on the impact scale for today, we really don't have anything that is in red, like yesterday where we had some high impact red events, like that's what they look like right there. We don't have any for today. That doesn't mean that any one of these couldn't turn into an event that moves the market. The market doesn't look like it's seeking out any new information. Sometimes we're on hold waiting on data, and other times the market's on a move. It seems comfortable with the decision that it's made, and it doesn't seem like it's looking for new information yet. But we do have OPEX to focus on. That's for tomorrow. And so it's possible that we could pin, like the founders talked about at Spot Gamma. It's worth reading that document if you haven't yet. And when more and more of the nations around us start cutting, it's going to put more pressure on the Fed to cut. That by itself is just another data point. I don't even rank it very high, but it is there. It does exist. There's political reasons, there's global reasons. It's not an isolated event that the Fed can just stand strong and say, we ain't cutting. They can do it, but they need backing, right? They need to know that someone's got their back. And if they don't have that due to political wins, then maybe we get a cut anyways. I hope they don't cut, but that's just me. Save it until they need it. It's kind of where I come. Of course, they don't do things that make sense. So there's no reason that this would be any different. We're above the call wall. There is another firm that does options on futures and gives us levels like these call walls. And they have a call wall at 53.50. It's a small wall. It's a 0-day wall. It's only good for today. They always do like a 0-day wall. So, just kind of keep it in mind. I reference it often, even if you don't see the line. It's an options level. It's how I usually reference it. 53.50 is an options level. If we move to the upside, that's going to be an area to fight through. We do have a voodoo line right here too at 53.49.5, close enough to 53.50. So that resistance is between us and the ADR line 53.60. The volume is in, it's kind of light, 65, but it looks better than yesterday at 51 or on Tuesday at 47 and Monday 47 and 40. So we got some volume. It's still a little light, but it's good enough. What we have to worry about now is a wash, cycling back through that big move that we had yesterday. There's a concept of mean reversion, moving too far too fast. And we have to be concerned with the idea that we might pull back into yesterday's levels. One of the things that you want to do is measure yesterday's level. Now we can call that a trend. And so of course we can add something like the 786. If we have a market in a trend and it begins to pull back, it should not pull back more than a 786. If it does, then it starts to call into question the trend. If we do break 786, which is the 53.30, 53.22, if we do break that, we'll go to the round number 5,300, which is an options level. Pivot point is buried in here with all that stuff on here. So you can see the range for today is an even bigger range than yesterday. The wider the range, the more likely we go sideways in price. It's bullish from the idea that today's channel is completely outside of yesterday's channel and above it. It is bullish that we're above the pivot point. Yesterday was a MDP, a missed daily pivot. We never hit that pivot. Markets hit their pivot about 80% of the time. So when they don't, it's doing something unusual. It's bullish. Not like we didn't already know that, but it's bullish. Today, so far, we haven't hit the pivot. That's also bullish. The pivot is on a cog line, so it's double support, potential support. And the wide channel tells us that today is more likely to be a range day than a trend day. When we think about how high we're gapped up and how high we should go, in this gap up, if we had gapped higher than the R1, we would expect R1 to hold as support, and we would just continue that gap to the upside. If we opened on it or underneath it, we would expect to fall back down and test the pivot. So opening above it would be bullish from the expectation that we could bounce on it as a potential support. We're not open yet. We're talking about RTH for the Globex. If we can run in Globex and get up there before the open, then that would count. Otherwise, as we come into the open and we're underneath this R1, the expectation is that the central pivot is going to be the magnet and that the close of yesterday is going to be the support that we would have to break to get to that magnet. Easiest way to find the close from yesterday is just to go to a daily chart. That way there's no disagreement about 4 o'clock close, 4:15 close, 5 o'clock close. Just use the daily close. Whatever that is, there's your daily close. So if we break 53.30, we're very likely going to go to the cog line 53.11. We won't get any help out of VWAP because we're at VWAP. In fact, we're underneath it. If we break the 511, then we'll look for the roundy. If we break that, then we aim for S1. As you can see, the put wall is a long ways off. They didn't roll that up. It would be bullish as a bias if they rolled that put wall up. Ten-day, 30-minute volume profile. We're going to lose this lower end as the day goes by. So just to kind of visualize by Monday when we come in, if we have not continued to run higher, this will be what our profile looks like. It's very likely that we won't get a movement in this point of control. We can see already that we've spent quite a bit of time up here, but we're not seeing any true volume up there. So they're not putting in like a topping volume. We got a new VPOC from yesterday. $26.75. And it's not a very clean profile. We can see where they tried to top it out at the RTH Open. They tried to top it out after that really big move up. And then they tried to top it out there at the end of the day. And that's really what we came back to at the end. I point this out because, yesterday there was multiple times where it looked like that was the end of the run. And yet we hadn't hit all the levels yet. And so I kept pointing to the upside. And they tried to back it off. That's where that selling came in. But it just got picked right back up again. And it seemed like every time I would call the next level higher, we'd get a really good pullback. Then it would make that next leg up to the next level and the next level and the next level. These are tricky days to play. But it's just a repeat of a day that we've seen before, right? And that's what you have to keep in mind. If you want to find ways to trade that better, find old examples where we did the same thing and study it. Today, this narrow range really stands out. The big question at this point is, did we move too far, too fast? And does it owe us a pullback? This lower indicator is distance from 10, and we're looking at the distance from 10 on a daily time frame. We can see in the past, we've been far away from the 10, 3%, 4%, just 4% way back here. So we've been a long ways from the 10 before. It does happen. But more often than not, we stay under a 2% move. For this year alone, just looking at January all through this year, 1.5%'s been our turning point. We pause there and consolidate, and or we reverse and move back towards the 10. We close that distance. This is the first time that we've been this far away from the 10 this year. That's okay. But it does suggest that we're a little overbought in the short term. That yes, we have moved too far, too fast, and that we could mean revert a little bit. the thing is, this distance from 10, it can be closed if we just stay in one spot. We don't even have to go anywhere. We just stay here and the 10 will move up to us. It'll close that distance. If we move down even a little and the 10 continues to move towards us at the same time, then we'll close that gap a lot quicker than you would think. The weekly range is between this green line and this red line. This is how far we were supposed to move for the entire week. We've already made it plus some. And we're supposed to close inside that box 7 out of 10 times is a 1 standard deviation. The S&P has an even more accurate expected move than other products, and so it's 8 out of 10 times. So the numbers say we should close inside that box. That box means we would be back down below 5,300. Now we can close outside the box. We did last week. We can do it again. It's just statistics and odds. The odds say we should close in that box more often than we don't close in the box on Friday at the end of the week. That's what the odds say. But this was a really healthy, strong breakout. And the market's irrationality can go longer than our statistics, right? So level by level, if you're going to play that short back inside of yesterday's range and back inside this box, one key metric will be, are we still outside of yesterday's range? No, we popped out. We've already come back in. Are we still above the close? Yes. As long as we're above that close, there's no short to even consider. If we break yesterday's close, then we've got a potential short and we could focus on that 5,300. Just remember 786, which is 53.22. Because if this is a trend that wants a decent pullback, that'll be the pullback measurement. And this is nothing more than how a market moves, right? It goes up, it pulls back to 786, it breaks out into a 1, 2, 3, 6, pulls back again, and then up into the next one, and then the next one, and then the next one. This is a 5-day change label in blue on all 9 of these sectors. So it's basically asking, hey, over the last 5 days, what has the 9 sectors done? They're all green. They're all positive. So, okay, that doesn't sound so bad. How many are blue skies new highs? 1. Utilities. Not the FANGs or the MAG 7 or, all those big growth names. Well, I misspoke. We got those 2. Just barely. We got tech. So tech and utilities, both. That's not a capital rotation. That's a rising tide. Remember, it's not growth against value. We're not asking which one is going up and which one is going down like a teeter-totter. It's growth versus value on which one of those is stronger. They can both be bullish. They can both be bearish. But which one is stronger? That's what we do when we look at growth versus value. This says both growth and value. Everything, every sector, every industry, everything. Now, granted, this is only 9. right? So we don't have communications, biotechnology. I don't have real estate on here. This isn't everything, but it's the top ones, right? If you have this market, you've got the market. And this is not telling us that we're overbought. Look at how many of these aren't even at their highs. Out of 9, 7 are not at their highs. So we got plenty of room to the upside in this broader market move. And it is a rising tide. It's the phrase, a rising tide lifts all boats. That's important because at one point last year, the 7 names did all the work and carried the rest of the market. It would be better if we had all the names working together so that those 7 don't have to do all the work by themselves. Bonds are up too. Isn't that nice? Risk parity is dead. Someone said that it died with COVID. I like that. I like that phrase so much. COVID killed it. Bitcoin is up, but not aggressively so. Nat gas is leading the way, and you never want nat gas to lead the way. China ADRs behind that. So what is up the most? What's that? China, pot stocks, uranium, bonds, China again, Bitcoin, and that's it. That's where we stop right there. I think maybe Walmart must have had a good earnings, so staples are up. Yeah, Walmart had a good earnings. That'll be good for Costco. Oh yeah. Costco's running with a bid ask of 790 to 793. Not really sticking it through yet, but it's showing up a little. So Walmart is in blue skies. They're up here around 63.75. So somewhere way up here. We can take this island, measure that. Looky there. You can't make that up, right? The concern is since its last earnings and then this split, that it had that nice pop up, a decent run, and then it's just been fading and fading and fading since then. And now another gap up, and now we're up here somewhere. It's a little bit of a concern that we've left some significant gaps behind. This one from the last earnings and now the new one that we've made. I wouldn't be surprised if we retest that 62 on a pullback. Obviously, it's still bullish. When I did my deep dive on Walmart a few years ago, their room for growth from their online sales at the time was only 8%. They had 8% growth or 8% sales online. That was their number one thing that they could improve to change revenue. I haven't had a chance to hear their data today. I don't know how much their online sales is, but I'm betting it's better than 8%, which is where it was when I did my deep dive a few years back. And as they continue to improve on that, it goes to the heart of why we continue to expect them to do good. They just have competition with Amazon. So for the China ADRs, Baba's up a little bit, completely outside of yesterday's range. I want to use that as the test. If we fade at all, needs to hold above yesterday's range. Baidu, this thing is just trash all over the place. PDD, I mean, it tried the breakout already and it came right back in again. Looking at it on the higher time frame, it's got a lot of work to do. Right now, that 143 seems to really be the area where sellers continue to come in. You see that defense. So until they wipe that liquidity out, it's going to be hard to see PDD get into that 143 and above. JD has a really nice breakout here, but I don't like this big dark pool print. This is why. Big dark pool print gets reset. So big dark pool print. Who knows? Maybe we go up a little bit, but then we get that opportunity or that test to try to reset. We can see pot stocks are up this morning, but they're not looking very good. And uranium's up, but it's already trying to fade back in. Bonds are looking good. It's hard to see it any other way. Just keep in mind, this is a very clear signal. Lower highs, lower lows, lower highs, lower lows. That hasn't changed for a long time. And if you're looking for, like some textbook legitimate signal, we'd have to get higher than this high way back here. That's a long ways off. We're talking $95 and we're at 90, call it 92.75. Until we get way up there and we break that, there's not even an argument that this downtrend is done. It's still in a downtrend, a full up legitimate downtrend. Along the way, we could pull back and set another higher low and then run up. And that would give us, a higher high, and then another two higher highs with two higher lows. That's a trend to the upside. But we would still need to get through that 95. So I like bonds. They're looking good. But if we're looking to run bonds, back up to 105 and eventually, back into 110, that longer term duration swing trade, we don't have a signal for that yet. You can dabble a little bit and just, start a small position and slowly add as it continues to prove that it's doing good. But this isn't a signal for, a large portfolio position. Not yet. That's what I got for you guys. Be careful, be safe.